All right, this is Marco Palmero, founder of Ulysses in Dubai. In this video, I want to talk about the process of selling a small business. And I want to do that because I had discussion with some potential clients who were looking to sell their assets, sell their small business, and they were very unsure about the steps they needed to take in order to do everything correctly. And so I'm going to share my personal experience in valuing businesses when we go ahead and look at companies to acquire, so that you as a seller can then know what are the things that you need to have, what are the items that you need to take care of if you want to get to the finish line and ultimately sell your company. So hopefully I will be able to boil things down to their essence, make them very simple and clean for you to understand. So let's jump right in. And before we actually talk about the sale process itself, let's talk about things you can do before you actually go to market and start selling your business. Many times I see business owners that are kind of delusional about their price expectations, and many times that happens because people have a figure in their mind and they don't look at the business for what it really is. They don't logically ascertain what they can get in the current market for that particular asset, but they just think that because they worked for 20, 30 years in a certain business, they want to X out of that particular company. The point is, the real world doesn't work that way. And in order for sellers to be more logical about this, it might be a good idea to get an initial valuation report done by somebody, a third party, an external firm, so that you can clearly get a price range and a kind of like manage expectation to some respect. That will clearly enable you to understand what your company's worth in today's market and some of the things that you can possibly do to make the company better over time. And why do I think that is good for a lot of business owners? Because many times I see people that come to market and then they wind up being disappointed because the offers they get are not up to their expectations. The point is their expectation was not matching the market, and the market doesn't care about how much money do you want for your business. There are tons of assets that go up for sale, and if it's not your business that's going to get purchased, chances are buyers will find another one. So my point is, we want, and you generally will want, to come to market with a clear expectation that is also something that the market can accommodate. And so valuing the business beforehand can give you a clear picture of what the company is all about. And if that price range is acceptable for you, then you can go ahead and list your business. Or if the price is not acceptable, then you will have a certain list of items that you can work on to make the business better over the next 12, 24 months, and then potentially list it at that point so that you can get the amount of money that you want out of it. That is, again, a little bit of a side note, but I think it's important because many times people go to the market right away and then they don't get what they want. They wind up going through all the due diligence process, and then at the end of it, they're unable to make a deal. So potentially getting your business valued beforehand can be a good solution for you. And those are reasonable investments that you can make as a business owner. It doesn't cost you tons of money to get your company valued, and you can get a clear feedback of the prices that are available in the current market. Now, in addition to that, you also might want to work with somebody to improve the business over time. So let's say that you already know that there are some things that you can do better in your business, or you find them through the valuation report. Then you can either fix the business on your own or work with somebody who can help you make the business better over time. Now, once you get to that point, and let's say that you've done all your preparation and you're now ready to go to market and sell your company, it is important to understand that all buyers will ask you for certain documentation. And so you got to be prepared to provide that type of documents to people in order for you to, make a clean and pristine sale. There is no point in not providing that stuff early on, hoping that people will not ask it, because any reasonable buyer will have a due diligence process, a process of control that they want to go through to make sure the asset is what they believe it is. And if you don't follow these steps and all the boxes are not checking, then you're not going to be able to make a sale. So my point is, assuming you're ready to go to market, then you want your company to be ready for a sale. And that means you want to have clear records from a financial perspective, legal perspective. Your contracts need to be available. Employment contracts need to be available for review, licenses, all this kind of stuff. So of course, there are different things that you might need to prepare, subject to the industry, subject to the company size. That really depends on what kind of business we're talking about. But the point is, you got to be prepared to share information because people are going to ask for it. Now, let's just assume that you got all that information and you're ready to go to market. Then it all comes down to, how do you want to go about selling your business? Do you want to do that on your own? Do you want to do that through a third party? What are the solutions available to you? Well, you can do that through brokers. You can hire investment bankers that will represent you. If you know and you have good accounting and legal firms that are representing you as third parties, they might be the ones that are going to support you in identifying buyers. Alternatively, you can do and sell the business on your own. I don't generally like that idea. Personally, when I look at an asset that we want to buy as Ulysses, I always look for sellers that have representation, if not investment bankers, at least their own lawyers or accounting firms, because that is, in my opinion, mandatory, and it is an important thing to have. So I would recommend you have third parties that work with you for this process. It doesn't matter if it is investment bankers, your own lawyers, accountants. Generally, I like the idea of having lawyers and accounting for sure, and then maybe investment bankers as a plus. But that, again, it all comes down to you. Brokers and investment bankers will surely charge you a fee for selling the business. And that is something that you need to be prepared to pay. Generally, is a percentage of the sale that you're going to pay to them once the deal is completed. So be aware of that. If that is acceptable to you, then you can go ahead and hire one of these firms to represent you in the sale process. Now, what are some of the things that you also want to consider when working with other parties? Well, working with other parties will give you access to more network of buyers and potentially a quicker transaction. Of course, these are professionals that have a strong level of connectivity in the market, and as a consequence, they can really support you in finding suitable buyers. If you go about it on your own, you might still find a good buyer, but it might be more complicated. It might take more time. So it really comes down to you and what your priorities are. Again, this is not legal or financial advice. If you have external legal and accounting firm, I recommend you talk to them. They're going to be the best ones to work on this process for you. The point is, you can do a sale either directly or with a third party. The point is, once you have documentation ready and you're ready to go to market, you can start talking with buyers and see what are the offers that come in. And generally speaking, the process that we follow, at least at Ulysses, when evaluating a business is pretty straightforward. We start with a non-disclosure agreement that we sign to protect confidentiality of the seller. Then we review some basic information about the company, generally, historical financials and something like that. We proceed then in providing a preliminary valuation, a letter of interest, letter of intent, which is something that kind of clarifies the initial structures of the deal. If that is acceptable from both sides, then we proceed with due diligence, which is the in-depth analysis of the business. That is, of course, the process I mentioned to you, the one where you will need to provide a lot of stuff. And if that checks out, then we move forward with purchase and sales agreement, which is the final document that then closes the deal. Now, of course, I'm oversimplifying here. There are a lot more details that go into that. But from a high level point of view, this is how the process of selling a business will look like, especially when it comes to a small business, because we're talking about small assets here. There will not be a lot of complexity in the deal, and that will make the whole process straightforward for you as a seller. So unless you have complex structures with multiple shareholders and different companies with holding structures and so on and so forth, and you just have your own, let's say, LLC or LTD, and you're looking to sell it, the whole process will be pretty simple and pretty easy. And again, your advisors will be more than able to support you on the entire process. Now, what are the timelines for a sale? That really depends on the level of responsiveness between the two parties, and when do you want to get a deal done? I mean, how fast do you want to get a deal done? There are solutions where you can get deals done in 30, 45 days, but those are subject to particular solutions and structures. There might not be commercial financing or big parties involved, because that will drag the process for a long period of time. There might be some seller financing involved and other creative solutions. But the point I'm getting at is processes can go from 30, 45 days up to 90, 120, even more if the deal is complex. But of course, we're talking about small assets, so that shouldn't really be the case unless there's something bad that happens in the deal, some red flag that pops out in the middle of the transaction. My point is, the whole process of selling your company becomes a lot easier if you're supported by somebody who knows how to go through these steps. And the whole thing will make a lot more sense to you, because you will have somebody who can also act on your behalf and protect your own interest. And many times I've seen small business owners who didn't want representation, and I actually forced them to get representation, and I was the buyer, because we wanted them to fully understand what they were getting themselves into, and we wanted to have transparency between the two sides. And that is something that I always want in each transaction, because if there's no clarity from the very beginning, chances are the transaction is going to implode at some point. And we as buyers don't want to see that happening. Of course, you as a seller don't want to see that happening. And so my point is, if you are seriously thinking about selling your business, probably working with somebody as third party is the right idea. And they will be the best party to support you throughout all these steps, and they will know what to do every step of the way. Now, the preparation, from my perspective, is the most important part, because what I see time and time again is small deals that fall apart because sellers are not prepared. They don't have the documents available. They don't have the historical data for the business available. And once buyers don't get that information within a reasonable time frame, they're going to pull out of the deal, and the seller is going to be left hanging. As a consequence, you want to avoid that at all cost, so that you don't kill a deal just because you haven't been careful enough to prepare all the stuff that was required. My point is, planning is generally what enables you to have a smoother sales process. And if you take care of these items correctly, then you're going to have the ability to work through the other steps a lot quicker. So the NDA, the initial offer letter, the due diligence, and the purchase and sales agreement. So those are just a couple of things that I thought I would share to hopefully clarify a little bit the sale process and the process of selling a small business. Hope you find this video helpful, by the way.